think we're good to go. Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it. How's it going, Ben? We are back again for episode 3 of the Amateur Investors. Welcome back, everyone, if you're watching on YouTube or listening to us on any of your podcast browsers. How's it going, Ben?
Chris, I'm doing well. I'm really excited. It's kind of crazy to think that we're already in a cadence where we're able to say the number 3. It feels like a small number, but to me, it's a big number. I mean, we've already built a routine in this, so let's keep it going as a weekly cadence. But no, I'm feeling good. The weather's pretty warm here in the New Jersey, New York area. Got some waves this weekend, so I'm excited to talk about stocks and investing. Let's do it.
For those that don't know, Ben is an avid skimboarder, a very good one at best. I am not good, so we'll show blooper clips of me on it one day and Ben tearing it up on the waves, shredding it. But I guess let's just get right into it. So, Ben, we've been talking about investing. We've been talking about stocks and bonds. So how would one go about starting off with investing? What would you recommend for someone that knows nothing about it, what platforms to use or where to get started or where to look?
Yeah, the idea for this episode honestly came from a question from our audience, Dimple. So thank you for asking this question about like, how do I get started investing with a little bit of money? And I think really what that question boils down to is, what money do I have to invest? And I think the number one thing that I'd recommend for folks that are thinking about getting started with investing is it all starts with your budget. I think it feels difficult and complex to really nail down the details of how you start investing. It's like, oh, what stocks am I going to pick? What ETFs, whatever. I think the most important thing is like how many dollars do I have per month, per year to even start investing. So there's a lot of ways to do that. You could first write down your bills, take a look at your bank account statement or your credit card statement, find out, or even use Mint. We're again not sponsored by Mint, maybe one day.
One day, hopefully
one day. It's a really good app. I like it. Understand what you're spending on food, whether that be groceries, restaurants, if you buy clothes. Understand where your expenses are going. Knowing where your money is going is a really powerful tool, is to understand what are your expenses. And then from there, I think in terms of percentage, how much of a percentage of my paycheck can I put forth to investing? And Warren Buffett always has this great quote, pay yourself first. That's like the key to success here is, you're always worried about paying the bills. You have to pay Trader Joe's or Wegmans or wherever you are in the country or the world buying your groceries, but make sure that you put $1 towards yourself. And that all comes with, we'll talk through some strategies to do that. But make sure you understand how much money you have to even start investing. So my first tip is make a budget.
Yeah.
What about you, Chris?
Yeah, no, so that's a great point. I know that's kind of one of my favorite quotes as well, that Warren Buffett always says, pay yourself first. It's very easy to get caught up in the expenses of life, your credit card bills, your car bills, your rent, whatever. I really look at investing, even especially for the long term. That's what a lot of us are doing. When you're investing for the long term, you're paying yourself in the future. And imagine you take a little bit less money now today to pay yourself a lot more money in the future, whether that is, 10, 20, 30, 40 years, however many years you have left of your investing career. I'd like to believe that I'll be a lifelong investor, but when I retire and start need to taking money off the table, that's when I'm paying myself and hopefully put myself in a larger income class than when I am currently working. But at least that's the goal. At least with investing too, getting started earlier is better. And we can always talk a lot about, how investing at a young age can really increase your net worth and how much money you have when you retire, when you look to retire, basically.
Yeah, Chris, that's a great point. I think, I'm generalizing here, but I tend to think that a lot of people think about life in terms of checkpoints. I'm excited to graduate high school. I'm looking forward to going to the best college or graduate from college, get that job. And then there seems to be, maybe this is a near quarter life crisis. What is that next step? I'm thinking about retirement. I know it's far, hopefully not. But I think a lot of people tend to think, once I have saved X amount of money, then I'll start investing for my future, for that home, for that car, for that thing. Or once I make this salary, I'll start investing into my future. I think that, and we're gonna definitely gonna talk about it. Sort of the disruption of these zero trade, zero commission apps have produced in the space of public accessibility to public markets. Robinhood, WeBull. Um, I think investing, even very, very little, pays tremendous returns in the long run. You can't make a return on $0. I mean, that's just how it is. So if you're saying I'll wait until next year or 10 years to start investing, you have made $0 in return. If you'd invested $1 today and you made 10% on that, well, now you're 10 cents richer. I think that's a nice feeling to know that the little bit that I do will have results. At the end of the day, you investing a little bit now will pay off in the future. And that's what I try to share with my friends and try and hold the mantra to myself is doing a little will always be better than 0%. You can compound on 1%, you can compound on 0.0001%, but you cannot have the benefit of compound interest on zero. So I think the key is to one, build that budget, and then figure out a way to start. And I think starting starts with research. Chris, do you want to walk through maybe how you do research or how you tried and learned just the basics of investing? What are some resources that you tried to leverage?
So I guess before we get into that, I like
Sure.
the story of, paying yourself first. And there's a pretty famous story. I might butcher this a little, but we'll give it a go. So there's a story of two guys, or there's Adam and Bob. And Adam starts investing at 22. They both graduate from college, similar majors, similar life paths, similar careers, all that. So they make the same salary. I think like $50,000 is what they assume. And they say Adam starts investing 10% of his money, or $5,000 at the age of 22. And he puts that away religiously. He keeps putting that away every year up until he gets to 32. And then after his salary had slowly grown, he was still just putting away $5,000 a year. He stops because he's like, okay, now I'm going to enjoy life. I'm going to have a little bit more money on the side. I can, enjoy my life and my money. Then there's Bob, who said, oh, I have so many expenses. I have college debt. I have to get a new car for my job. I need to rent a new place, all that. So he off-puts saving money or investing his income at 10% until he gets to 32. So at 32, Adam stops investing and is like, I'm going to enjoy life. Bob starts investing at 32. But the difference of Bob, instead of investing from 32 to 42, he invests from 32 to when he retires at 62. And after all that time, you'd think, oh, well, Bob put in 30 years of investing, $5,000 a year. And Adam put in only $5,000 every year up until he was 32. If I asked you, who do you think would have more money in the end? I think a lot of people would assume, definitely Bob. He did it for 30 years, where Adam only did it for 10, but it's been growing for 40 years. And I'll pull up the numbers in the show notes, but at the end of it, Adam still has another $175,000 or $200,000 more than Bob. And that really shows the magnitude of time. Time is your biggest asset. The younger you can start, whether you're at 15 or 18 or 22, the sooner you can start, the better. That only keeps compounding your money further and further. And there's many other stories. The story of, would you rather $1 million today, or would you rather a penny that doubles 31 times or 31 days in a 31-day month? Which one would you rather have? And most people would be like, oh, $1 million today, that's worth so much more than just a penny doubling every day. But if you look at it, if a penny doubled by the 32nd day, it's I think $5 million or $2 million. Like I said, I'm butchering a lot of the numbers, but it just shows the power and the magnitude of investing.
Yeah, I think that's the key. I know people always talk about, passive, there's always ads on YouTube follow my course and I'll make you a millionaire with passive income. Passive income is difficult, but I think investing is the closest thing to truly passive income, where you put your money in something and then it just makes money. Because these companies, like we talked about in our previous show, these stocks are real companies doing work, on the factory lines, putting out apps and widgets. You're getting access to those profits of those employees doing all of the hard work. Stocks are a means with which to get access to that. And I think that's what makes investing so powerful and again, it's not about being young necessarily. It's just about, starting as soon as possible is the best thing that you can do. Doing something now is the best thing you can do to have your money start making money for you. I think maybe something what we were talking about this before, is breaking down the cadence of how you allocate those monies, where it's like, I have my budget, I save for the bills, for the food, and then you have your retirement accounts. But again, your retirement accounts won't make you retire early. It's 59 and a half. So you also have to have those separate accounts, those individual taxables for specific goals. So maybe we should talk about some of the places to invest and then what you can invest in, whether it's ETFs or things like that. What do you want to kick us off with?
Yeah, so I'll kind of get us started then. I think this is just me, personal experience. We'll talk about, if you are an employee for a company, or even if you work for the government, or, you're in a union such as a teacher, the best place to start is with your 401k or your 403b if you're a government employee in the United States, at least. And basically what that is, it's a retirement, an account that, like Ben was saying, you can only start taking money out at 59 and a half. So you're truly paying yourself in the future. But the benefit of it is it's normally your company has a collection of index funds, mutual funds, stocks, bonds, and things that are in there that you can put money or a percentage of whatever you're investing to diversify your portfolio. So I'm a big proponent of index funds because they are basically mapping the S&P 500, which is a collection of the top 500 companies in the United States. And what it is, it's fractions of it. And over time, I don't want to get ahead of myself now. It's a collection of the 500 companies. And when you're investing, let's just say $100, it breaks up
about index funds generally,
Yeah. So it's a collection of companies that is trying to map, you're trying to take advantage of the best 500 companies in the United States. So basically what it's doing is, if you invest, let's just say $100, it's putting $1 in the number one company. Then it's putting 95 cents in the second best company. Then it's putting 80 cents in the third best company, as it works its way down to, a penny or however a percentage of it that's in the 500 best company. And so what's that's doing over time, as let's just say the number one falls down to number 5, you're slowly putting less money in that, but you're still getting the advantage of it being a top 5 company or a top 10 company. And over time with 500, that's the diversification, or 30 or 50, or different indexes have different amounts of companies that they're investing in. You're taking advantage of the best companies in that sector or in the United States, or even you can do a broader index funds for international stuff. But basically the benefit of the 401k is normally your company gives you a collection of these index funds that you can invest in through a company like Charles Schwab, a T. Rowe Price, a JP Morgan. But a lot of the benefits of employers will pay you if you invest at least 7% or 5%, we're going to match up to 4% or 5%. So that's free money on the table. That's like an additional 5% of your income, or 4% or 3%. It varies company by company, that they give you for free, that the company puts money towards your retirement to help you. Any comments on that? Sorry, I was long.
No, you're perfect. I think that we should maybe do a whole bit on retirement accounts, because that's so specific. It's such a specific goal, but this concept of indexing, I think, is so generally applicable to all types of funds. And I mean funds as in an IRA, a 401k, a general just brokerage account. This indexing strategy is so powerful. Because exactly to Chris's point, and he was referring specifically to like an S&P 500 index funds, there are index funds that follow a bunch of different indexes or indices, which are essentially just, again, what Chris said, a group of stocks. It's essentially, you get to buy, Chris Alaimo's portfolio
Yeah.
without having to do the picks themselves. And just like what Chris was saying, you don't have to worry about picking the next best thing, because if you're doing an S&P 500 index fund, that fund is already changing all the time. So you never have to worry about like, oh, what if this one company goes bankrupt? Well, you have 499 other companies that will float the
Offset
boat
it.
for
Yeah,
you.
exactly.
And my rule of thumb about diversification in sort of retirement accounts or like ETFing or index fund strategies, I like to break up my diversified funds diversificate like in a diversified way. So my breakdown is I'll have a large cap index fund or mutual fund, mid cap. So, middle sized companies, we'll link out like what the market cap is for those. So it's large cap, mid cap, small cap, some exposure to international. There's some really good international funds out there that give you exposure. And I'm happy to link, my Roth IRA and what I'm invested in if
Yeah,
people want to see
definitely.
that. I'm sure you would too, Chris.
Yeah,
An
definitely.
S&P 500 index fund, just to get that passive strategy. Just historically, the U.S. market, the S&P 500 has outperformed over long periods of time over really almost any strategy. And then maybe an actively managed fund if you can find something with a low expense ratio. So
Yeah.
you can get a diversified strategy in a diversified portfolio. You don't have to just pick that one fund. You can pick a bunch of funds. And if your employer, or even if you're doing something independently through an IRA, that would be my suggestion, is to get exposure to a few different things. But within those index funds, you're pretty safe because there's someone, and usually a big team, trying to find those companies that are gonna weather a lot of types of storms. So I'm a major proponent, if you're just getting started, is build out an index fund portfolio, whether it be 1 or 10.
Yeah, definitely. And then I guess next on the list, so after you max out, you get the most, once you hit that max number, if it's 7% to get 4% from your company, once you hit that, my next thing, ticket item would be a health savings account. So it's kind of weird that I'm going health to talk about saving money, but a health savings account is you put money pre-tax into an account that can go towards your medical expenses. Not all plans have this. It's kind of more of, the perks of some plans, medical benefits plans. Obviously, if you don't have benefits, it's unfortunate because it's a great thing to have. So basically what that means is, let's just say I make $50,000 a year and my HSA has a max contribution for the year of $5,000. So I put $5,000 from my money before tax into that. So instead of paying taxes on $50,000, my salary comes down to $45,000, and I only pay tax on $45,000. People are like, "Well, Chris, like you're making $5,000 less dollars. Like, how is that a good thing?" Well, when you make the $50,000, yeah, like the extra 5,000 would be nice to have. But when you're taxed at, let's just say your tax bracket is for that is 25%, that means before you even see any of that $5,000, you'd only have, what is that, 3,750, I think. So you'd lose $1,000 because your taxable income is that much higher. And also, HSAs are awesome because in a way, it's also an investment account. So your taxable income for the year is less, but also on top of that, you have money that can go towards paying, literally, like, I need to go to the doctor, it's $100 to go to the doctor. I need to go, I broke my nose one year, which is a true story. We can talk about that another time. It was $1,800. And I just took that right out of my HSA account, and I didn't charge anything. Like, it's not like a bill that I had to charge because I had money in my HSA to cover that.
And no taxes on that, right?
Yep, there's no taxes on that. And the best thing is, at the end of your, it follows you for life. So even if you leave a company and then you have to go to a new company that doesn't have an HSA, that money literally follows you, that you can always use for health plans. And then even when you retire, that becomes basically like a 401k or a Roth IRA. So basically you can use that as investment. My dad personally, he leaves $10,000 for our family, that if we have any medical expenditures that we need to cover in there. And then I think he has additional money above that he uses almost like an investment account. He can pick stocks, bonds, mutual funds, stuff like that with that account, basically. It's very cool. It's a great thing. Any comments to that, Ben?
Yeah, no, I think that's fantastic. I've heard about the HSA quite a bit, and I've done my own research. I'm luckily still on my parents' benefits right now, but this is my last year. So I think
I'm a
maybe
little bit older, guy, so I had to be on my own
Chris is
benefits for
full of
my own.
wisdom. Still full of youth though. Yeah, so maybe we do a walkthrough when I'm ready to, get my
Definitely.
HSA set up, because I'm gonna have some questions for you too, Chris. So we could probably do a live thing there,
Yeah,
of
definitely.
Ben Gassaway picking his benefits and trying to be an adult.
And it's funny, I was never really taking full advantage of it. I was putting about $1,000 a year, but my parents kind of like I did ran some numbers, and they're like, you should be maxing this out. Like it's only a good thing. You're lowering your income, but you're paying yourself. So I'm like, and it's even one of those things. Once you take distributions, then you pay taxes on it, obviously on the capital gains, but you're not even taxed on. I think I don't want to misspeak here. I don't think you're taxed on the money that you go in there, but I'll have to check on that. But
Yeah, double
anyway,
check that. Maybe go just follow up. We'll red font it.
yeah,
Website is coming, so
yeah,
we'll have some red font in there.
yeah.
Um, I think that's the key. And I want to talk, and Chris, feel free to challenge me on my third suggestion here. And then we can start talking about just general investing stuff. I think that the key to being a savvy investor is to, as legally as possible, not pay taxes.
Yeah,
the,
and
the
sorry to cut you off there. I mean, that's quite literally what the 1%, and the 1%, I mean, like the billionaires do. They legally, I mean, otherwise they would all be in jail, or at least you'd hope so, avoiding taxes. And it, I, it's kind of one of those things that you're like, it's like, I don't want to say like avoid taxes. They do it legally, and paying taxes is an important thing. It helps the community. It helps the roads. There's a lot of benefits to paying taxes that the government does to help people out. But yeah, basically what they do is they look at taxes as an expense, which it is, and they pay lower taxes by different tax havens or offsetting expenses or losses and different things to avoid paying taxes. I mean, Amazon, for what you think about them, it's kind of what they are really good at doing. They don't pay any federal income tax, or at least they haven't in the better part of at least 10 or 12 years now, it seems.
Yeah, so I think the key is to circumvent having to pay taxes on taxes you've already paid in the form of your paycheck. I think that you're overutilizing these retirement accounts, and we're talking 401k, 403b, right, Chris?
Yep, 403B.
HSA, and then once you have maxed out those, if they are in your disposal and you fall within the salary limits, my next best recommendation would be an IRA. And my personal preference is the Roth IRA. So again, talking about avoiding taxes, just the key is like you're already getting taxed on your salary. So you should be able to invest in your future. I'm a firm believer in that.
Yeah.
Investing in your future in a frictionless way. So you want to maximize those opportunities. I mean, the government were the people who established these vehicles. So you might as well utilize them. This is not something that's sneaky. These are things that have been approved by the US government. Use them. If they are giving you a way to avoid taxes, do it. So there are really, when I'm talking about the IRA and 401k, there are really four ways to do it. You have your traditional 401k, you have your Roth 401k, and then you have your traditional IRA, and then your Roth IRA. The difference between the Roth and the traditional is just the order in which taxes occur. So when you get paid in your paycheck, you will get taxed. It's just your income tax. From there, you can take that money and invest in a Roth IRA. And then once that money is growing and you've invested in it, when you're ready to retire, you don't get taxed on your contributions, and you don't get taxed on any of your capital gains, zero. So if you have, let's say, $1 million in your Roth IRA, which is awesome, you can do that. You have $1 million. The difference between that and the traditional is what happens at your paycheck. You don't get taxed yet. Your company so it depends on how you file your taxes. With a 401k, your benefits or compensation folks will put that money in your 401k and then tax your smaller paycheck. So what that might actually cause, and like will have some benefit, it could lower your tax bracket there, but the detriment to that is you would have to pay taxes at retirement. And me personally, just knowing, and we've talked about this, Chris, plenty, is my guess is that taxes will go up over time. It just makes sense. I would much rather pay taxes now, get it out of the way, so that when I'm ready to retire, I can use my money however I want and not worry about taxes being friction to how I want to live my lifestyle. I've already put in years and years and decades of effort into these accounts, why shouldn't I have that money? So the Roth profile is my favorite. Just differentiating between the Roth IRA, or let's just talk about IRA 401k. The limits of 401k, as in like the amount of money you can contribute per year, has nothing to do with the IRA. So the IRA for 2021 is going to be $7,000. Max that puppy out if you can, and if you fall within the salary bracket. So I think my favorite thing to do, max out that 401k. If you have it, max out your HSA, then max out your retirement account. And if you don't have a 401k, go right to the IRA. That's the next best thing.
Yeah, and kind of going along with Ben was saying, I know we're kind of throwing a lot of numbers for the 401k. It's $19,500 is the max you can put in that. The IRA is $7,000 right now. So if you add those up, that's what, 26,500. Is that correct? Obviously, we're saying not everyone obviously has the max amount of money they can put in. That is a lot of money year on year. Ben and I, or at least I'll speak for myself, I know that I am not maxing both of them. The most important thing is do what you can. If it's $100 a month, it's $100 a week. If it's $50 a month, if it's $100 for the year, you need the sooner you start, the better. And the more you can do as you grow your income over time, the better. Kind of the rule of thumb for me is when I started out of college, I was making a lot less money than I was now. So in order, and I was getting paid on a chemistry salary, or a chemist salary with a degree in chemical engineering. So in order to compensate the lower salary, I was putting 20% of my income into my retirement savings. And I was kind of living on a shoestring budget, don't get me wrong. And then after a year, I took a new job as more of an engineering role, and I quite literally overnight, like, increased my salary by like 30%. But then I was still putting 20% away. So even though I had way more money in my salary or paycheck at the end of every month to pay, I was still putting that 20% of that new larger number, 30% more, into retirement savings. So I didn't even miss it because I had way more money than I had ever had before. And I was living less on a hysteria budget and enjoying my life a little bit more upon increasing my salary.
Yeah, Chris, that's a great point. And I know I kind of hammered the limits sort of arbitrarily, but I think graphics tend to make things a little bit better. Think about your week or biweekly, weekly, monthly paychecks, or even just your annual salary as a pie chart, and then break out like how much is going towards bills, how much is going towards expenses like life, food, surviving. And then I think what we're talking about is like a prioritization, like making sure that, your retirement accounts are the big slice. Give those the bigger slice than you would give, your emergency fund. The emergency fund has to be there. And we didn't mention that specifically on this episode, but look for a high yield savings account. Savings accounts are like dead money. And then from there, you're basically just trying to make sure that the pieces of the pie fit your pie chart. It's not that I have to hit that max number, because that might not be possible. And there's absolutely nothing wrong with that, because what you're doing with any amount of that slice is something that you can eat in retirement. And that's a great thing. But if you don't fill that slice with any money, then you'll be starving at retirement. Hopefully not literally, but the pie chart is unique to you. And don't worry about what Chris or I are doing in terms of like percentages, or I think have a goal that makes sense to you, and be honest and forgiving with that goal, because whatever you can do, and if you're consistent with it, I think you should be really proud of that, because it's really hard to do anything more than just pay your bills and live. Honestly, it's hard.
Yeah.
So just make it work for yourself, I think would be my suggestion there.
Yeah. So for exactly kind of what Ben's going off. So after this, I've been in the working world a little over 5 years now. So I've been really hammering into my 401k. I started putting into my HSA. And then my next thing is kind of moving to our next topic, is kind of how to get started too with like kind of individual stock picking or evaluating companies one by one. So I use personally Robinhood. I also have a little bit of money in WeBull. Like I said, we're not sponsored by both these accounts. It's just kind of two things that we use. My thing is with you're doing, it's, I guess, higher risk in the sense that you're picking individual stocks or they have cryptocurrencies on there as well. But kind of with Robinhood, it's more liquid. So while you're tied down with the 401k and the IRA and even your HSA, you can't make withdrawals of those with some exceptions for first time home purchase and stuff. you can't see that money till 59 and a half. So what I'm currently doing is I have a Robinhood account and I'm putting money in individual stocks. I've done quite well over the last year or so, barring, the right times with investing and stuff. And we can talk about investing mistakes and definitely later episodes of things that we've done wrong or well with WeBull or Robinhood. But basically, I've been investing additional money to try and do further investments in the future. So obviously, I'm planning on buying a house one day, hope to get married one day. So there's a wedding cost. And there's different things. So it's when I'm putting all that money into your retirement accounts, it's not money that you could see for till you're 59 and a half, with the exceptions of medical bills and housing. So what I'm doing with Robinhood is I'm still putting money on the side that if I lose all of it, I'm okay. I'd be disappointed, obviously, but I'm growing money passively. So then when I have expenses like a house or a car or things like that, I can liquidize that cash or, sell those positions in whatever shares, pay taxes on it, but then use that money that I've grown to then purchase new assets or items that I need paid off, loans, bills, college, house, whatever. So I'm I'm hedging money on the side I can use more immediately. So that's just personally what I do. And Ben, you could talk about that as well if you'd like.
Yeah, so I think of like the Robinhood, or honestly, I mean, there's just so many brokerages to choose from. Robinhood was the one that got me started with investing, just because of the frictionless entry and just the low barrier to entry with just like the zero trade fees and zero commissions. I'm a big fan of Robinhood just because that's what I use personally. It's not something that I'm thinking about for short-term goals necessarily. I have a separate portfolio for that. And that's something I want to talk about after this. But what I really, really like about Robinhood as a tool to get started, get some skin in the game, is they support fractional shares. And to my understanding, they can support as little as $1 per share that you can buy. So if Amazon is whatever, $3,000, it'll probably be $10,000 tomorrow. You can buy $1 of an Amazon share. And I think the smallest in terms of fraction, if it's a very large dollar share, like Berkshire Hathaway is like 300,000 or 400,000 per share, you can buy as little as 1/1,000,000th of a share. So what's really nice about that, if you want to get some skin in the game and like sort of like, for me, I need to be held accountable to do something. I need there to be consequence, just because that gives me a sense of urgency. And that's just how I operate. So if you want to start learning about investing, maybe take a look at, you can type in, if you have a 401k, maybe type in one of your funds that you're invested in and type in top 10 holdings. Look at those companies, decide maybe, what, I have heard of Google. Maybe that's a company I invest in. Maybe I put in $1 into Google in my Robinhood account. And what's really nice about that is if you want to make a fund, and my personal opinion, I think 15 companies, if you're going to stock pick, I think is the most that you should have in an individual stock portfolio. I have more right now and I'm trying to get more focused as I learn. But the key to investing is, one, do your research. I think a lot of people jump right in and just are like, I'm just going to buy random things. That's fine if you're only going to put $15 up. But when you start to get more involved with the individual stock picking, you want to be able to follow these companies. Like, let's say, we find out antitrust has passed and Google has to be broken up into 100 different companies. Well, maybe you don't buy Google today, even if it's $1. Losing $1 is not worth it if you can avoid that. So my opinion, you can really make a dream portfolio with only a few dollars with these partial shares. So I think deploy that tool. It's a really nice thing to do.
Yeah.
That's my 2 cents about Robinhood. I know some other brokerages do that.
Yeah.
But I think it's good to have some skin in the game, but you can also make some fake paper trading accounts, which is a really good way to learn too.
Yeah, and it's funny you should say another great Warren Buffett quote. I mean, we've been blessed with his knowledge for literally years. But he always said to his students, if I could have you a punch card, like kind of one of those things that you'd use for like Rita's Italian Ice, like after you come 20 times, you get a free Italian Ice or whatever, or however many haircuts you go to, 10 haircuts, you get a free haircut. He said, if I could limit my students to only 20 stocks over their entire life, they were only allowed to pick these 20 stocks. You'd think long and hard before you pick a stock that you're like, this is going to go up in value versus, it'll go bankrupt. So really, we can talk about evaluating stocks. That's a whole nother episode.
Absolutely.
But basically looking at the financials, literally looking at financial statements, whether that's the income sheet, the balance sheet, or the cash flow statement, or all three of them in conjunction with one another, and looking at how healthy the company is based on how much money they're making, the top line revenue, the expenses, and you start going into operating expenses and all that. So he said, like, if you only had 20 stocks that you could pick, even if only 5 of them hit that you were like really confident on, you could become very, very wealthy with just 5 of 20 being right. And he always compares it to baseball. One of his books that he loves was The Science of Hitting, talking about breaking up the strike zone into, I believe, 72 different spots, or a baseball fitting in that strike zone of, from your chest down to your knees. So basically, he was saying basically where to hit the ball. And if you hit like 500, or you're batting 500, or you're an excellent hitter right down the middle, if you only wait for a pitch that's right down the middle, then that's where you should hit. If pitches are coming everywhere else in the strike zone, you should only wait for that perfect pitch. And, it's not time bound. It's not next month. It's not next year. It's every year you needed one. It's like, if you even have to wait 2, 3, 4, 5 years, for individual stock picking, at least. I know we were kind of saying in the beginning, the long-term index funds you should do as soon as possible, but for individual stock picking, or basically doing what he did, you can wait as long as possible, because all you need is to be right a quarter of the time, and that's perfect.
Yeah, that's a great way to think about it, Chris. I think something I have been working through, it is a mental exercise. I think the key to investing is just foregoing emotions, and taking the human element out of it. So picking stocks, and we're going to do an episode on like individual stock investing. I think we need to build up some of the basic discussions, because that's my favorite thing, is to talk about like the nitty gritty.
Yeah.
But I think like the key, and we talked about this early on, Warren Buffett's 2 rules is don't lose money. They're the same.
Yeah.
Don't lose money. So
2 are the same, in case you're wondering.
Yeah. And the best thing about, having access to public markets is the difference between this and like a 401k, where they're telling you what funds you can invest in. You can pick almost, I would say, literally every company in the world you can buy. So why would you settle for an okay company at an okay price? Like, get the absolute best companies. Like, you can invest in Amazon, you can invest in Google. They might be too pricey right now, but another opportunity will come. And if you truly have found a good business, whether you buy it this year or next year should not matter in the long run, because if that company is poised to succeed, they should be lasting into perpetuity, into foreverness. So we talked about, ETFing, indexing, which I think of as semi-passive. I think of the stock picking, the portfolio building as active. As an investor, I don't really want to even think about trading. I'm not a trader. I just don't even want to talk about it personally. Yeah. I think about that as the most active way to invest. I want to talk about, Chris, if you don't mind, just like fully passive investing with Robo Investing. Are you good with that?
Yeah, no, that works.
So something I do, and we were talking about this, is goal-oriented investing. What is really, really nice that I've been opining on and kind of playing with are these Robo Investing platforms. I've used a few, and the 2 that I'm using right now one is Betterment, one is Fundrise. The Fundrise is real estate exposure. We can talk about that as a separate episode.
I'm also into Fundrise as well. I think,
have any. Chris, you should lead a real estate episode one day.
Yeah,
you're definitely the knowledge person on that. I cannot speak too intelligently about that, but I can share my experience with Fundrise and my thoughts as a potential home buyer one day. I really like Betterment personally because I've used it so far. Essentially what you do is, this is exactly pay yourself first. You can set, I think, as low as like $10 maybe, once per month, once every 2 months. It goes right into your Betterment account. The Betterment fund managers will invest your money in ETFs, and they're all like Vanguard or low expense ratio, very, very cheap funds that give you exposure to the S&P 500, large companies in a diverse way, and they make trades and move your money around to optimize tax loss. They call it tax loss harvesting. So as you're getting closer to, the end of a taxable year, they might sell off some of your equity to write it off as a wash sale or just a tax deductible expense. So they're managing your money fully for you. And you can even set it up as specifically as what is my risk tolerance, and they can auto adjust it over time. So let's say I'm 24, they might set up a portfolio that's 90% stocks, 10% bonds. Automatically, Betterment, as I age, will adjust that portfolio to match the right risk. So they're literally, it's even more passive than my 401k where I'm investing in my funds. But you can set up a regular recurring investment schedule, and they diversify for you, and they move all your money around, and you think about literally nothing. All you do is input money into Betterment, and they invest for you. And honestly, it's really done quite well for the past 2.5 years for me. And what's nice about that system, I think Wealthfront is similar. It's a competitor to Betterment. You can set goal-oriented portfolios, so I can have up to like 10 or even more. I have no idea. I'd have to check. But I can have a house portfolio where it's like, okay, I want to have a lower risk, so maybe I have more bonds in that portfolio. I'm going to buy a house in 10 years. I put maybe $10 in that a month or whatever, 50, whatever I can do. And then the next one might be, I want to buy a new car, or the next one is I want to buy a second house. I'm not doing that. That's not in the foresights just yet. But you can set up these portfolios where it's like, okay, I'm saving up for these types of goals by time. So whether it's vacation, car, house, retirement, you can even do that. I think it's a really nice way to separate your money into one account. So I'm a big fan of the Robo Investing. If you want to get started, that's a great way to start today.
Yeah.
You don't even need to research anything.
And even Acorns, very similar concept. It's just rolling up to the next dollar. So let's just say you buy something for $7.50. They would roll it up to $8, and that extra 50 cents would be charged to you, to your credit card or whatever. It goes to your Acorns account, and they take that 50 cents and they start investing that. Exactly what Ben was saying with Betterment. Yeah, Fundrise is kind of the last one. That's kind of basically you're investing in its, I guess, when did that company start? Like 4 or 5 years ago? It's kind of,
it was like 2012.
you might be right. But basically, it's a company that
right
you're basically buying into a fund of real estate investments. So the way that it works is you're buying, you give them money, you give them $1,000, $500, $100, whatever it is, and you put it into an account, and they buy it into projects. So there'll be like 80 projects, and you can see even what projects are grouped in your portfolio of what you paid for. As those projects either get built or they acquire those apartment complexes, they give you back a dividend, a quarterly dividend, basically. A quarterly dividend that basically pays you money from the rental income that they're getting from those properties. So if they buy an apartment complex with 100 apartments, and each of those apartments, 70 of them are filled, and they pay an income of $2,000 a month for each one of those apartment complexes in Florida, you get a fractional, like a few bucks from whatever amount that you put in back to you as a dividend investment once a quarter. Or actually, did they do monthly or quarter? I forget now.
I have to check. Honestly, what I've noticed is it pays daily, actually.
Oh, okay.
It's really interesting. Fundrise is a really interesting concept. I was doing a little background Googling there, 2010, Chris. But what's really interesting about Fundrise is it's crowdfunded. So like my dollar that I invest into Fundrise is buying a property somewhere, or investing in the debt of a property, which would be, that's usually lower risk, where you're just like, they're basically investing in a physical asset. And what Fundrise is, it's REITs, it's REIT, it's a real estate investment trust, but it's crowd funded. So it's a very pointed investment portfolio that Fundrise investors are funding. And in addition to the dividends, when they make a sale or an exit on a property, they distribute that in the form of an appreciation capital sale. So you'll get money there, not just dividends for like the passive rental income. They also make money on whether it's a debt exit strategy or physically selling a property. And what's really nice about that platform is they show you like the blueprints of like sort of in a 3D simplified model, but you can physically see what the property is going to look like. They show you updates. It's a pretty nice and aesthetically pleasing platform. So if you want some real estate exposure without the risk of having to put money into a property, REITs just generally, I mean, you can buy these. Vanguard has one. It's VNQ. I know that's the Vanguard Real Estate Fund. Fundrise and Cadre, which is Cadre is very expensive to get into. The barrier to entry is high there, but Fundrise is great. I think it's $1,000 minimum, but that's a really great way not to front a ton of capital at risk to buy real property in the right place, right time. They do it all for you, just like how Betterment's managing the companies or the stock holdings for you. Fundrise is managing the properties for you. So
Yeah. Yeah, so I guess that's pretty much it on the day. I know we talked about 401ks, HSAs, 403bs. Sorry, lumped that in with 401ks. I talked about IRAs. We've talked about passive investing. We've talked about active investing. And I think that's pretty much it for today. Like I said, if you ever want to reach out to us, you can see us on all our social media platforms, Facebook, Twitter, Instagram. We're in the process of making a TikTok, YouTube, obviously, to watch our videos and comment below. Our website will be coming shortly, and always every Wednesday. I think that's going to be our day. We're going to try and make a video or video and podcast dropping every Wednesday morning. So thanks, guys. Ben, if you have any closing remarks, and then we'll get out of here.
Yeah, please reach out with any thoughts about whether it's an episode suggestion or questions. We're going to make sure that all of our audience members get their questions answered. I mean, that's really important to us. That's why we're doing this, is to make it as helpful for people as possible. I just love this process. I know you do too, Chris.
Yeah.
And in the meantime, there's just so many resources out there to learn in between. Like, we're going to continue to share resources, but leverage the power of YouTube. Be wary of scams that'll make you a millionaire overnight. Investopedia is a great resource. And just keep learning. I think we're going to make sure that we point you guys in the right directions. But yeah, Chris, this is a great episode. Thanks for watching, guys.
It's been a blast, guys. Well, there was one more thing I wanted to point out. Questions. We got a bunch of questions from our viewers. We weren't able to put this in with this episode. We kind of had this one already planned out. But episode 4, we will be answering questions that were sent in to us via social media or friends or family or whatever. So we're really excited for it. It's been a blast, but we'll see you guys next Wednesday. Have a good one, guys.
Thanks, everyone.